Thank you for tuning into this webinar jointly hosted by Ceres and the Asia Investor Group on Climate Change, AIGCC. This webinar is part of the Ceres Investor Water Hub speaker series where we bring together expertise from academia, research, and investors on water. This month we're focusing on a recent brief released by AIGCC, Manulife Investment Management, and China Water Risk focused on the question, are Asia's pension funds ready for climate change? This brief looks into pension fund exposure to water and climate risks in Asia, as well as the economic impacts and disruption to trade flows and supply chains in the region. A link to the brief was shared in the reminder for this webinar, and we'll also circulate it again in the follow-up. My name is Robin Miller, and I'm a manager at Ceres focused on supporting investor engagement on our water program. I will be sharing the moderation of this webinar with Rebecca McCool, the director of AIGCC. Joining us are also Dorisha Mirando, the Water Risk Valuation Lead at China Water Risk, and Emily Chu, Managing Director and Global Head of ESG of Manulife Investment Management. Before I dive into the content, I'd like to provide a few logistical notes. For this webinar, all lines are muted except for our speakers. If you'd like to ask a question or have a comment, please type your question in at any point into the chat box at the bottom left, or you can also raise your hand and one of us will get back to you over the chat feature. The webinar is being recorded and we'll send a link to the recording out to all participants. The recording will also be posted on the Ceres Investor Water Toolkit page so you can listen back in and share with your networks. If you run into any technical issues, you can reach out to the numbers on this slide, and I will also put them in the chat box once it gets going. So in terms of the flow of the webinar, I'll give some framing and introductory remarks about Ceres and our work engaging investors on water risks and opportunities. I'm then going to turn it over to Rebecca to tell you more about AIGCC, and then we'll introduce our speakers, Emily and Dorisha, who are going to share some really great key findings from the brief. We'll then leave some time at the end for questions that you'll send in through the chat feature and a discussion before we wrap up. So who are we at Ceres? For 30 years, Ceres has worked with companies, investors, and other nonprofit organizations to drive sustainable solutions throughout the economy. As a sustainability nonprofit advocacy organization, we pursue this mission through 4 extensive networks that you can see on this slide: our investor network, our company network, the policy network, and our nonprofit network. This webinar is specifically put on by the Investor Water Hub as part of our educational speaker series, which highlights key learnings from academia, science, and investors themselves on the latest thinking on integrating water risks and opportunities into decision-making processes. For those of you who are new to our work at Ceres, the Investor Water Hub is a working group of the Ceres Investor Network. It began from a survey in 2015 of a small group of institutional investors to help identify the barriers to integrating water risks and opportunities into their decision-making. The findings of that survey were published in the Investor Water Handbook for Water Risk Integration, and a working group was formed to move forward on removing some of these barriers. We now have a group of over 100 institutional investors who represent more than $20 trillion in assets under management in this group. We're advised by leading investors and other peer investor networks. And last year, the Investor Water Hub released the Investor Water Toolkit, which is available online as well as PDF form, as a comprehensive resource on evaluating water risks and investment portfolios. I encourage you to take a look and interact with the data, the case studies, the risk frameworks online, and certainly be in touch with the team at Ceres to learn more. I just want to point out 2 key resources for you in the toolkit that may be of specific interest to those of you joining this webinar. The first one is an analysis of water risk exposure across major global indices. We found in our analysis that a majority of the global indices are exposed to medium or high water risks on an industry level. The Investor Water Toolkit features a much more detailed explanation of the methodology than we have time for in this webinar, so I encourage you to take a look. And the second is a case study on an approach to creating a portfolio-level footprint of water risk exposure. You can read the full case study on our website, and we're in the process of developing a portfolio water footprinting tool within the next year or two, so please stay tuned as we develop that. So I will leave you with contact information to reach out to myself and my colleagues at Ceres on the Investor Water Hub team, Monica Freeman and Hugh Brown. We welcome your feedback and interest in getting involved in this important and pressing work around a resource that's vital to all of us. So with this, I'm going to turn it over to my co-moderator, Rebecca McCool from AIGCC, to give you a bit more information about AIGCC and set up the context for this brief.
Thanks very much, Robin. Hi, everybody. Just checking that you can hear me okay there.
Yes, we can. Thank you.
Great. Thanks, Robin. Thanks, everyone, for joining today, and we're really grateful to Robin and Ceres for co-hosting this webinar with us. We're really excited to share the work that Ceres has been doing on water with the other investors and our members in Asia. And this is a great example of how the investor groups are collaborating on climate change and sharing this knowledge between the different regions and organisations. So this webinar is the fourth in a series of outreach and workshops with a range of investors in Asia. And we're delighted to be able to share this report with Ceres members and a broader group of investors. So just very briefly on AIGCC, hopefully most of you are aware of our organisation, but just to remind you that we are a Pan-Asian industry association that focuses solely on climate change and how that impacts investors' portfolios and policies, and help them to integrate that into the work that they do. So as in similar way to Ceres, we encourage peer-to-peer collaboration and learning about the increasing impacts and the risks and opportunities, of course, that climate change presents to investors' portfolios. So we have a platform where we work with our members and broader stakeholders to develop tools and resources by the investors for investors. We're helping to build critical investor capacity in the region, and we do this through a variety of projects and events and in-person meetings and, of course, virtual meetings such as this one around the region. So for the investors that may not be in Asia, what AIGCC can provide to some of our international members who are not based in the region and others who may be on the line today is insight into the developments in Asia around climate change. Progress that investors are making, provide examples of what investors in Asia are doing in incorporating climate change into their portfolios, and also on the regulatory environment and what's happening, especially in regards to the Task Force on Climate-Related Financial Disclosures and the progress with financial regulators and other policymakers in the region. So AIGCC has 31 members, with over $4 trillion in US dollars in assets under management. We have a range of members based in the region, a mix of asset owners and managers, and then some of our members are also based internationally. And again, we have that mix of asset owners, asset managers, and other service providers. But importantly, these are our public-facing members, but we also engage with other key investors, government pension funds and sovereign wealth funds in the Asia region, because we've identified that those investors, the largest and most critical investors within their own markets, we need to engage with them on climate change and also work with them. And that is part of the reason why we developed this report today that we'll talk a bit more about. So I mentioned some of the projects that we've worked on, and these are developed by our members. They identify needs that they have in helping them across various elements of integrating climate change. And so we developed these reports, tools and resources for Asian investors, but also these are also broadly applicable to other investors in other regions, of course, as well. And we work with our international peers on some collaborative works, including the sector expectations reports that we use as part of the Climate Action 100+ engagement series. And this is just to show you we've got obviously Ceres and AIGCC on this webinar, and our other investor partner networks, the European Institutional Investor Group on Climate Change and the Australian New Zealand Investor Group on Climate Change. So I'm just going to hand over to Emily Chu, who's an AIGCC member, and we're really grateful for Emily and the work that she has put into the development of this report, along with Durisha Mirando at China Water Risk. And Emily will go into a little bit more of the background as to why we developed this report, but we felt that it was necessary to provide a bit more of a macro look at the implications of climate change across markets in Asia and how the pension funds in those particular markets may be impacted, and to use this report as an engagement tool to have discussions and to have workshops and webinars such as this to provide greater information in detail and to stimulate those conversations and see how we can help provide some of the information that they may need and some of the key recommendations that they can start asking internally to help them think about how they need to accelerate their implementation and integration of climate change into their portfolios. So with that, I will hand over to Emily Chu from Manulife Asset Management and to provide some of the insights into the report. Thanks very much, Emily.
Thanks, Rebecca, and thank you, Robin and Rebecca, for putting this webinar together. It's a pleasure to be able to share some of the findings from this report that we co-authored together with AIGCC and China Water Risk. So I'm Emily Chu. I'm Head of ESG at Manulife Investment Management, currently based in Boston, but previously was based in Hong Kong and Beijing for several years working in the ESG space. And I suppose the context for this report is really some of the observations that I found working across the region, promoting ESG, promoting more awareness of climate change in investing, and dealing with a lot of different players across the financial markets, but particularly focused on the asset owner community throughout the region, and had a lot of opportunities to meet people who work at asset owner institutions, at pension funds, at sovereign wealth funds, did various trainings with different groups over the years, and always noticed that in my conversations with them about ESG, there was always tended to be a concern about how do our domestic companies perform on ESG? How do they benchmark with their global peers on ESG practices, and almost a concern to make sure that the domestic companies were doing really well on ESG factors. And I wanted to understand that a little bit better, and kind of came to realize over a period of time that Asian asset owners in particular are very concentrated in their domestic markets, both across their equities and bonds. And in order I knew this from working in the industry, but in order to kind of give some data to that notion, or some truth to that idea, we researched the asset allocation of about 30 of the largest institutions in the region, public pension funds, sovereign wealth funds, and central banks, etc., all of which are playing a critical long-term role in their markets to provide pensions and basically a default social security system for the public in the absence of a stronger social security system. And we found that of those 30 or so, only about 50% of them publicly disclose their asset mix. So there isn't a lot of transparency necessarily, but we did feel that there was enough to give some evidence to this notion that there is a domestic skew in the asset allocation of this group of institutions. So on average, there was 64% of the portfolio invested in domestic equities and bonds. Now, for some of the smaller countries outside of perhaps China or Japan, that's a very, very high allocation, average allocation to have. If you were, say, a U.S. pension fund and you would perhaps looking at your asset allocation, a large allocation to U.S. bonds and equities would not perhaps be out of the norm because it's a very large market globally. But for some of the smaller countries, this is a very high concentration. Now, there's several valid reasons why that concentration may be there. In some cases, it's actually required by regulation that these pension funds or asset owners have this kind of concentration in their market. There's a certain minimum amount they must invest domestically. And part of the reason for that is that these public institutions play a very important role to provide an anchor to the capital markets. So they are helping these markets to not be so volatile to international capital coming in and out, depending on interest rates, depending on what's happening in other parts of the world. And so there are these quasi-political reasons. There may also just be the usual reasons of you invest in what you know and what you understand. And we see that domestic orientation everywhere, that preference for investors to invest in something that they understand. You tend to understand the companies and the systems and the economies that are immediately around you. So we have this reality here that asset owners are very important. In some cases, they, the value of their fund is a very large chunk of the potential GDP. We have very good reasons for this domestic orientation. But what we also know from speaking to institutions across the region is that in general, there isn't very advanced policies, frameworks, procedures, or people, staff that can help these pension funds integrate these concerns around ESG and climate into their investment process or into the asset allocation. So of these 30 institutions that we reviewed, only 4 described ESG policies or investment principles along the lines of an ESG policy. Usually they don't actually disclose the policies, but they disclose the fact that they have some kind of a policy. Around 8 or so described actions indicating that some level of ESG integration is happening in the investment process or in fund manager selection. And about 8 or so had made actual allocations to ESG themed or climate themed funds. But that's obviously out of 30, a small minority that's actually acting. And so what we find here is very high concentration to domestic markets, not a lot of formal ESG integration activity that's publicly disclosed yet. And then when we look and consider the climate risk of the region, what we also know from the UN and others, the Asian Development Bank has covered this at length. What we also know is that Asia as a region is more exposed to the costs and the impacts of climate change than other regions. So to test this idea, we took the MSCI All Country World Index, so the 8,500 or so names that are on that index, and we applied the carbon delta methodology looking at different climate change scenarios and the potential value at risk at the company level under these different types of scenarios, as well as the potential opportunities. So on this first chart here, if we think about the Task Force on Climate-Related Financial Disclosures, the TCFD framework, the TCFD framework very helpfully sets out risk on the one hand being a combination of transition risk and physical risk, and then business opportunity from the climate transition. So on this chart, we have policy risk or transition risk on the left-hand side and potential opportunity capture on the right-hand side. And what we see when it comes to policy risk or transition risk is that Asia as a region, represented by the red bars, under all scenarios, has the most potential value at risk when you add up all of the names of companies that are classified as Asian compared to the other regions. And what we also notice is that as the temperature, the assumed temperature rise decreases from say 3 to 1.5 degrees, the potential regulatory cost of that burden on Asian companies is actually multiplies, it actually grows exponentially. It's not a linear kind of progression. But what we also see is that looking at carbon delta's patent database, so they've mapped thousands of patents to thousands of companies, taking data that's available from the web and doing an incredible mapping exercise and identifying those patents which are potentially could be monetized in a low carbon type of innovation. What we also see is that Asia has by far the biggest opportunity based on what we know today around the low carbon related patents owned by Asian companies. So that is, we thought, quite striking. So if companies were to actually organize and move, this potential policy risk could be offset. However, regardless of the policy risk and the potential to offset that through opportunities, what we also know is that Asia as a region is exposed to an incredible amount of physical risk. And this is the point that's perhaps been emphasized the most by the UN and by the Asian Development Bank and other institutions. So again, what Carbon Delta is doing here is looking at about 500,000 or so different facilities mapped to 5 kilometer square patches, longitude and latitudinal patches across the world, and then mapping these facilities to various different types of climate risk, physical risks such as extreme heat, extreme cold, storm surge, drought, and then also mapping these 500,000 facilities to the about 25,000 companies. And on the left-hand side, the chart that's a little bit hidden, you have your baseline scenario. To the forefront, you have your aggressive scenario around physical risk. And what the assumption is that over the next 15 years, the amount of climate change that we're going to, even if we were to act swiftly in accordance with the Paris Agreement to try to limit temperature rise, there's still a certain amount of climate change that's already baked into the system based on the amount of carbon that's already in the atmosphere. And so this physical risk, if you like, is an inevitability. It's baked into the system. And under both scenarios, if you look on the far left-hand side of both charts, again, Asia comes out, the Asian companies on the ACWI index come out as having the most value costs to bear because of physical risk, because of that physical risk that's baked in, the temperature change that's already baked in. And what we see, obviously in the Hong Kong context, we're very familiar with tropical cyclones, but the coastal flooding is also a concern because we have so many large cities that are coastal in the Asian region, so much industry based on delta regions and river basins that are close to the sea, a point that Durisha will make a bit further on. And there's also heat risk. When certain conditions get too hot, certain operations need to actually shut down because it's too hot to operate certain equipment, it's too hot to effectively cool certain buildings, etc. So that is the kind of predicament that I think we find ourselves in now as either as Asian asset owners, but frankly as investors who are focused on the Asian region. If you are investing in the Asian region, these are issues that you can't afford to ignore. So with that, I'd like to pass on to my co-presenter Durisha, who will talk more about the water risks, and then we'll come back together at the end to hopefully not end on too depressing a note and talk about some of the recommendations made in the report about what we can do from here. So Durisha, over to you.
Thanks, Emily. Just checking that everybody can hear me clearly. Robin?
Yes, we can hear you.
Okay, perfect. So thank you again, AIGCC and Ceres, for putting this webinar together. And thank you, everybody, for dialing in and for logging in from all your different locations. I can see a few familiar names, but for those of you who don't know China Water Risk, or CWR for short, we're an NGO think tank based in Hong Kong. And what we're trying to do is to get more financial institutions and corporates to start embedding water and climate risks into their daily operations, because it's clearly financially material, as Emily has already shown, and I will go into a little bit more detail on some of this as well. So we've been around since 2011, and we've worked with a number of financial institutions, including CLSA, UBS, JP Morgan, HSBC, to name a few, where we've written reports, some of these publicly available, but others just for their client base or for their internal processes, and also done a few presentations and teaching sessions about these risks so that they can understand them a little bit more. Because the problem is a lot of these issues, as Emily just said, they're already baked into the system. And we're actually on a path to 3 degrees Celsius of global warming, not the 1.5 to 2 degrees that we would like to achieve. Yet, 92% of all climate finance is going towards mitigation, but obviously there's a lot of impacts that we're going to feel no matter what we do, so we need to invest more in adaptation. And financial institutions have a key part to play in this because they need to start considering all these risks within their investment portfolios. So being based in Hong Kong, we can see that China is really taking this seriously. They're doing a lot on the regulatory side, but they're also trying to get their financial institutions, their banks, to consider this. Last year, they published a report, the first report for financial institutions on environmental risk assessment. And CWR, we co-wrote or co-authored the water risk chapter. The report is 400 pages. It's pretty long, but it's also only in Mandarin at the moment. So again, not accessible to everybody. So just to go back to the presentation, the bulk of the presentation, I want to talk about water because when we think about climate change, the conversation quite often is about the carbon risk. But water is going to be the most, and is already the most vulnerable to climate change and is being impacted quite heavily. And water is also important for our economies because we need it for everything, whether it's agriculture, whether it's power generation, industry, for our day-to-day use, we need it. Yet in Asia, we're facing something called a triple threat, which is a term we coined at CWR last year in a report called No Water, No Growth. So the first part of this triple threat is that there are certain countries and regions that don't actually have that much water, especially within their current development models and economic models, which are very water intensive and polluting. And to highlight what I mean when I say not that much water, let's take the US. It uses about 16% of its water resources, and with that, it's able to achieve a GDP per capita of $50,000. If China tried to use the same physical amount of water, it would be using about 76% of all of its water, which is not sustainable. India actually doesn't even have all of that water to be able to use it every day, so it would be using more than 100%. So this gives you a little bit of an idea of what I mean when I say there are limited water resources. So these countries and regions cannot follow the very water-intensive and polluting economic models that they've been following actually for the last decades. And they can't emulate the US model either, which has also been quite water-intensive. So the second part of this triple threat is climate change. Because it exacerbates this water scarcity. Climate change is not just about more severe floods and cyclones and typhoons. It's also about droughts and changing weather patterns. So monsoon patterns that we've been relying on for agriculture in certain areas, it's not happening anymore. Or it's happening at a different time of year, or it's actually happening in a different area. So it's raining heavily in parts of the country where the infrastructure has not been built. There aren't reservoirs there. But also global warming means that our glaciers are melting because it's actually getting warmer there than it is down here at sea level, which impacts our river flow, which again is very important for Asian economies. And the third part of this triple threat is the clustering of all our assets, our people, along river basins, because we are all attracted to the same areas, and urbanization rates in Asia are just increasing. They're not going to stop anytime soon, which means we have more people, more GDP being generated from the exact same areas that could be highly affected by water scarcity, extreme weather events, etc. I would like you to have a look at this map. So this is a map that we developed for the No Water, No Growth report I mentioned earlier. We mapped out the 10 major rivers in Asia that all flow from this, the third pole you can see in the middle, called the Himalayan Hindu Kush, which is our glaciers. And just within these 10 rivers, there are over 1.77 billion people and about $4.3 trillion of GDP is generated every year. So each of those dots is a city with more than 300,000 people, and there are 280 plus of those. And you can test out your geography because you can see there are some that have actually over 20 million people. And these cities are not slowing down anytime soon. They're all growing. We estimate that just in these 10 rivers, about 50% of them are already facing water stress, and this is only going to get worse. 4 of them are actually going to see shrinkages in their river flows. So you add that plus urbanization, and you can see what's going to happen. Looking at just 4 of these major rivers, Ganges, the Indus, the Yellow, and the Yangtze, all major rivers in Asia, but they don't have that much water. If we compare these to Lake Erie, which is the smallest of the Great Lakes in North America, we compare the annual average flow of these rivers. The Ganges won't fill 1 Lake Erie. The Indus barely fills half. The Yellow will only fill a fifth of it. The Yangtze looks okay. But then you can look at how much all of these rivers are supporting. For example, the Indus is supporting pretty much all of Pakistan's GDP and its population. Yet the Indus only is about 25% of Pakistan's surface water. Yet everything is concentrated along this river, putting more pressure and adding to the stress there. Now, obviously, if you look at the Yangtze, it looks better because it has a lot more water, but a fifth of China's GDP is generated there and a third of the population is there. So the government is taking this quite seriously. President Xi Jinping is worried about the Yangtze because of all of this, but also because about 65% of China's rice is grown there. And on the other hand, a significant amount of rare earth elements, which go into all high-tech equipment, including all of our smartphones, it's mined there, but it's a very dirty industry. Then you have chemical textile fibers. A large amount is also manufactured there. Again, not the cleanest. So you've got rice and all these other industries. And as a government, they're trying to pick which ones would they want around there, but also then putting caps on water use, on pollution, etc. So a lot of disruptions in the short term, but it's all about the long term to reduce resource use and pollution, but also protect these areas. We're actually writing a report at the moment looking at the Yangtze and all the different policies that are being put through in the area, and that report should come out in the next few months. But also, if you are interested in the pollution issues and what China is doing about it, our newsletter next month is going to be reviewing China's war on pollution. So if you sign up, you'll be able to see that in a bit more detail. So in the report that we have just published with AIGCC and Manulife, we look at a few different ways that capital markets could be affected by climate and water risks. I am just going to talk about a couple of these. And the first is the logistics sector, because Asia is made up of countries that are highly export-oriented. So there's a high reliance on ports as well as airports. The issue is that both of these infrastructures are at sea level and so would be highly affected by both storm surges and more frequent typhoons and cyclones, etc. So last year, a report was published by HSBC and ARE where they estimate that just in Asia, the ports will have to spend between $28 billion to $47 billion to adapt. And this includes investing in changing warehousing, lifting things up, changing the infrastructure, building storm surge seawalls, etc. But really, when you look at that number, it doesn't feel huge when you compare it to the impact that would happen to the economy if any of these things were affected continuously and couldn't actually work and function. So in the report, we looked at the Nikkei 225, and what we realized is that quite a large percentage of it, so we estimate a minimum of 30% of the index would be affected if anything happened to the ports. but also this with the airports as well. And I mean, last year in Osaka, Kansai Airport was really affected by the flooding and the storms, and it was out of action for quite a few days. And even in Hong Kong, closer to this region, the cost of the adaptation would be $1 billion for the port. But again, the GDP in Hong Kong, 20% of it is based on the logistics industry. So when you tally those up, the adaptation cost actually is not that dramatically high, because the cost of not doing it is actually much, much higher. The second sector I'd like to have a look at is the financial sector. Because in Asia, it makes up a huge percentage of all of our indexes. They're all very important banks and financial institutions. The issue is that most of them are not taking into consideration all the different risks I just mentioned. Extreme weather events might be looked at right now, but again, a lot of banks are relying on insurance agencies to take the risk. But they're not looking at the fact that water scarcity and pollution is deteriorating the local sources, which means that an organization or a project operating in that area is going to be affected. But also the government risk. If you're looking at China, that is a huge disruptor in the short term, because the policies are coming through very quickly and they're being implemented and monitored, which means that you need to be ready for them instead of waiting for them to hit first. But also on the flip side of that, it's the inaction as well. So let's take multiple countries in Asia where governments are not actually doing very much. So in the short term, maybe you'll be okay. Your investments will be fine because they don't have to adapt to all these different rules and efficiencies, etc. But they're not going to be protected in the longer term because that area might become a lot more water stressed and scarce, but also no seawalls are being built, no sponge cities are being built, etc., to take on some of the future impacts of climate change, which are going to be floods, droughts, etc. So that is also something that financial institutions currently are not really considering. And then the third thing that I really don't think anyone is looking at is this clustering risk. If a large percentage of your portfolio is located in one vulnerable area, whether it is because of climate change or water stress or government action, no one really knows this because they're not actually mapping any of their portfolios. So the only way to know if you have this clustering risk is to physically map it, because these are all very locational. And to be honest, I mean, in the very short term, it's also going to be part of your fiduciary duty. Just recently, the Network for Greening the Financial System, NGFS for short, which is made up of now 36 regulators and central banks, they just published a report where they said climate change is a financial risk and we need to start looking at this. The report focuses quite heavily on extreme weather as well as the carbon risk. But there's a part of the report where they say we haven't done enough on looking at water scarcity, pollution, deforestation, etc., and we need to do more. So we will be putting more resources towards that. So clearly there is there's a trend, there's a movement, and as an investor, I think it's always better to be ahead of the curve when it comes to your regulators. So I've given you a lot of information. Some of it looks pretty depressing, and there's a lot to think about. But I think, as Emily said, we want to end on something a bit more positive, because at the end of the day, managing your investment portfolio, a lot of these risks can be managed. So you can do something about it today. You don't have to wait. So the report has a list of recommendations. And I'm just going to talk through two of these before I hand back to Emily. The first is looking at these real physical risks within your portfolio. Because like I just said, all the risks are very, very locational. So the only way you fully understand if you're going to be affected by this is to map your portfolio. You don't have to start with everything, obviously, because that might be quite complicated and difficult, but you could start with one sector or one small portfolio. So start small. And you might want to get a third party to do this. So this is something that CWR does. But also you could do it yourself because there are already a lot of maps available that are open source, that are free, from organizations such as WRI, which is the World Resources Institute. So you can map your different assets onto what they already have, and then you can see if all your portfolio investments are going to be affected by this or not. And this mapping, like I said, will also highlight if your portfolio is very clustered in a certain area. And then you can also look at shadow pricing, for example, to look at the true cost of water, because this takes into account water stress in the different regions and the very micro locations. And you can plug that into your DCF model so that you get a better understanding of the valuations of a company, because it could be affected by water. Some might be fine, but you need to do these different analyses to understand that. And then the second is to really look at the regulations. This is not the easiest to do. I understand that because it's very micro, and it depends on the region and the country that you're looking at. In China, it's vast and it's always changing. We could have an entire session just talking about regulations in China, but I'm not going to do that now. But it's something that you do need to look at, both the short-term, medium-term, and long-term impacts of either government action or actually looking at if the government is doing anything at all. So with that, I'm going to hand back to Emily to finish off all the recommendations, and then I'd be happy to take your questions later.
Thanks, Darisha. So the third bullet point here, the recommended action, and obviously we've got many more sub-recommendations in the actual brief itself. But the third bullet point here is the idea of creating genuinely diversified portfolios. So at the moment, portfolio diversification is very much based on this idea of your benchmark index. And various asset owners set certain requirements on asset managers around benchmark tracking error, or being able to diversify away from a proposed allocation to sector or country based on a given benchmark. And I suppose what we're proposing here is that our diversification theory and the way in which we construct our asset allocation and our portfolio security selection needs to be properly climate and water risk adjusted. So that may mean driving investment towards companies that catalyze or benefit from the transition to a lower carbon, a more water secure economy. It may mean allocating away from sectors and companies globally that accelerate climate change, that are contributors to it, and also allocating away from sectors and companies that are most exposed to water and climate risks. But other than just genuine diversification and allocation, we also need to, as investors, be active participants in engaging with portfolio companies to actually try to improve resilience at the company level. So we propose in the report that investors not only use locational mapping to map their own portfolios, as Darisha recommended and suggested, but also that we encourage the portfolio companies to do this. In the work that we've done in this space around climate risk scenario analysis for our portfolio, what we've actually found is that companies haven't done this geospatial mapping themselves in relation to climate and water stress issues, and that in some cases they may not even have a complete list of where all of their locations are, where all of their operations are. We need to encourage the portfolio companies that we hold to be much more aware of regulation themselves. How are they going to be directly impacted by environmental regulation, climate and carbon regulation, as well as waternomic regulatory moves, some of the developments that Darisha referred to in her remarks. We need to conduct sector-specific engagements, so specific to the oil and gas industry versus the auto industry versus the agricultural companies, because some of them are much more vulnerable to transition risk, some are more vulnerable to physical risk. And the report goes into some detail in the various types of industries that we see as being most exposed to the kinds of physical water risks that Darisha outlined. And we also need to encourage companies to adopt better decision-relevant disclosure, such as the disclosure framework proposed by the TCFD. And then beyond engaging with companies and pursuing a truly diversified portfolio construction, we also need to, as investors, undertake a range of complementary initiatives. So under this bucket of recommendations, we included things like collaboration. So collaborating with like-minded investors to more effectively give companies a very clear direction and message around the direction on climate change and what investors would like to see. But collaborating with investors in this way is not necessarily a confrontational exercise. It can also be an exercise in which companies feel supported to start to take more bold action. Ultimately, we can use our voting rights if we're shareholders in order to send a message to companies who we feel are not responding over time to a program of engagement. What we'd also really like to see is asset owners engaging much more proactively and intelligently with their asset management service providers around how ESG and climate change considerations are being integrated into the process and into the services that they're being provided with. We do feel that at the moment, Asian asset owners could be doing a lot more here to interrogate this among their service providers. And then investors themselves can also work with organizations like the AIGCC and Ceres to engage with regulators to ultimately try to improve systemic resilience because of climate and water risks. So I think we'll end our remarks there, our formal remarks. And shall I hand back to you, Robin, or to Rebecca to take it from here?
Rebecca, I think I might hand it over to you to ask some of the questions that have been coming through the chat feature.
Sure, thanks, Robin, and thanks very much to Emily and Darisha for taking us through more detail in the background to the report and indeed the recommendations. We do have quite a few questions, so we'll dive straight into them. So a couple of questions that came up in Emily's earlier part of the presentation. The cost of policy at risk slide, and what is the time frame of this analysis, and did Manulife run this? And then also another question, can you talk about the sources of the place-based data? I might throw those two to Emily to start with.
Yes, sure. If we go back to this slide here, so the question around the cost of policy risk, what is the time frame? So this is an annual cost, projected cost, averaged out over the aggregate annual losses, averaged out over, I think, around a 15-year period. Because beyond that period of time, we don't feel we have enough transparency to do modeling at the company level. The second part of the question related to the technological opportunity analysis. So this is basically a patent database that has been built. So patent databases, many of them are actually publicly available, but the issue is sorting through the thousands and hundreds of thousands upon pieces of data that's available in these databases and actually drawing some meaning out of it. And what I'll speak here on behalf of Carbon Delta, but I really encourage you to look at their website and to reach out to them to find out more details about this analysis, because they're the experts. What they've essentially done is scraped all of these publicly available patent database records, created certain categories of patents which could be considered to have some kind of low carbon or green business application. And then they've had to basically draw some assumptions around if that company owns that patent and if they were to develop that technology as the temperature scenario gets lower, so as we move from a 3 degrees to a 1.5 degrees scenario, temperature rise scenario, the assumption is that the company would have monetized that patent that they own more vigorously or aggressively than if the temperature rise scenario remains high. The policy costs and technology opportunities numbers, they're actually for the ACWI index. So the MSCI All Country World Index, so this is 8,500 or so largest listed companies in the world are on this index. And what Carbon Delta did is assisted us to do this modeling across the entire index and came up with numbers, assumed policy cost numbers and transition opportunity numbers for each name on the index, and then we aggregated those numbers up by region. That's how the charts were produced.
Thanks very much, Emily. I think we've covered a couple of the questions there. I might go to Darisha this time, and actually a question came up, a pre-question before the webinar. How has Asia dealt with financial water risk insecurities thus far, if at all? That one for Darisha.
Thanks, Rebecca. I think in general, the water risk is still not really being looked at enough, and I think that's what I was trying to highlight when I was talking about the financial sector. But there's a lot more interest in this space. So a few years ago, we wrote a report called Toward Water Risk Valuation, where we looked at different ways of valuing water. So shadow pricing was one of them, but also mapping so that you can understand your balance sheet risk, as well as looking at regulations. And with the results, we surveyed over 70 odd investors, or we got replies from over 70 investors who had some interest in Asia and in particular in China. And the feedback was that about 45% of them did the survey because they want to embed water risk into their DCF models. But only a tiny percentage, 0 to 4%, were actually using any of the tools available. So there are already free tools that you can use to understand the shadow prices, etc., as well as, like I said, the mapping of your balance sheet risk. We have not redone the survey since then, so this was in 2016, to understand if more investors are actually incorporating these risks into their DCF models. But what I can say is from the conversations that we've been having so far that not very many are doing that at the moment.
Great, thanks, Darisha. And I might just stay with you, if that's okay. Another question came through that I think you can probably comment on about the water quality problems across the different scenarios that you mentioned.
Okay. I mean, I think the issue with the water quality is that pollution is still quite bad when you look at different Asian economies. China and India would be the biggest ones I would like to talk about. But, I mean, I think the stat is that about, don't quote me on this, but I think about 25% of China's water is still not good enough for human touch. I think that's the number, but again, don't take that number. But the government has been doing quite a lot, so that has actually improved significantly in the last few years. So they're putting in a lot of rules and regulations about what an industry can discharge now. So the rules were a lot more lax before, and now it's the level of the quality of the discharge has to be much higher to try and reduce all these pollution issues. Because one thing is having water scarcity, then you add pollution on top of that, and you make the problem a lot worse because you can't actually use more of this water, whether it's for agriculture or for industry. So that means that the costs are going up quite a lot because as an industry, as a factory, you need to invest in much more CapEx so that you can actually adhere to all these rules and regulations. And sometimes, to be honest, you're not actually given that much time to adhere to these. So this has led to a lot of organizations sometimes shutting down because they cannot afford all the costs. So in the report, we mention the textile industry because the industry is one of the top 3 most polluting, and China always talks about it as, we need to clean this up. And a few years ago, in 2015, we wrote a report with CLSA where we estimated that about 90% of the smaller manufacturers will have to close down because no way could they afford all of these costs. Last year, we surveyed about 85 of these manufacturers, and obviously there was 3 years, so some may have already shut down, but still about 14% said that they were still facing shutdown risk. But also quite significantly, about a third of them said that their operating costs have risen by more than 20%, and some of them it's as high as 60 to 80%, which gives you an idea of all the different regulations and rules coming through. I hope that answers the question.
Thanks very much, Darisha. Yes, I think that does in quite a lot of detail. Thanks very much for explaining that to us. So I'll just move on to the next question, which is a bit of a multi-layered one, perhaps to both of you, and I might go to Emily to respond initially. So the observation around Asia being most exposed to these climate and water risks is obviously really interesting. But what's the rationale behind this? Is that Asia is a victim of its own growth over the past decade, or is it that the production has led to this financial success, which is now leading to the high exposure for those climate risks? So what's the insight from a defensive and a proactive perspective? Emily, I might go to you first, and then to Darisha to respond to that.
Sure. I mean, I think that the reason for the asymmetry, why Asia is most exposed, I think it's partly. I mean, when we think about, I think we can answer the question a couple of levels. One is, why are the asset owners, or why are the institutions, the public institutions, so exposed? Because, and the rationale there is that they seem to be highly allocated to their own region. Then why is the region so exposed to losses? I think part of it is indeed the fact that there has been so much industry. The geography means that our communities, our cities are very coastal in nature. Our economies are still, in the region, are still very agrarian-based, and agrarian production is going to be heavily impacted by climate, as well as a lot of industrial manufacturing-type production as well. And so other regions that are perhaps not so, don't share the similar geographic characteristics, and which also don't have similar economic structure, are perhaps not as exposed in terms of value. So when we link value to companies. Now, of course, this doesn't cover necessarily biodiversity loss, which may be very, very steep in many regions around the world. It doesn't necessarily cover all kinds of health risks that may become more prevalent in other parts of the world as well because of climate change. What we were specifically looking at here is risk to companies as measured by the MSCI All Country World Index. Darisha, did you want to also speak to that question?
Yes, so I think it's twofold, and I think Emily's already mentioned this, but I think the first part is that our physical location in Asia means that we are just more prone to the impacts of climate change, whether it's more cyclones and typhoons, which we are already feeling. I mean, in Hong Kong, we had 2 super typhoons 1 year after another, which is very, very unusual. And it led to a lot of damage and flooding, etc. So it's the physical location of Asia, but also, as Emily said, it's the clustering of all our cities and our industries in the areas that are actually going to be most affected. And these cities are growing because urbanization rates are still less than 50% in a lot of parts of Asia. And these are all developing and growing. So this risk is only going to get greater and increase as time goes by.
Thanks very much, Darisha. There's still a couple more questions, but I think we might just take one last question, and we might I think we'd be happy to follow up with any unanswered questions offline. So I think this one will go to Emily. It's quite detailed. I'm not sure if everybody can see it there, but just talking about Asian asset managers and looking at active management for ESG and climate risk, and allocating to themed ETFs. So maybe I just might need to finish reading that out. It's quite detailed. So from what we've seen, the methodology seems to favour large companies, index heavyweights and those with good disclosure practices, rather than those who are proactive in addressing or harnessing the risks. For example, CLP is in the low carbon index, even though they burn coal, and increasingly gas. So directionally correct, but surprised to see the weighting there. The TCFD, the Task Force on Climate-Related Financial Disclosures, requires even more disclosure effort than this. So the risks that large companies with the resources to do so will stand out even more. Is there a discussion on the efficacy of indices? Over to you, Emily.
Okay, I'll try to be really brief here in my comments, but there's 2 points being made here. One is the bias in ESG data towards large cap companies who have the resources to track these issues in order to actually report on them effectively, but then also to be able to have programs in place to move directionally in the right direction in terms of addressing them. Yes, large cap companies do have the resources to communicate more effectively, to implement better programs. They're also the companies that are responsible for the most detrimental impact, usually. So I think that proportionally, that's somewhat fair. What you also find with very large cap companies is that they constantly are having ESG controversies of some description. So even if they've got the best practices, the best policies, they will always have infringements or controversies surrounding them for some reason, because they are just very large, complex companies. So yes, I do think the TCFD is going to be easier to adopt by larger companies. That doesn't mean it's not, the best framework that we have right now. And I suppose the challenge for us as an industry is to figure out how can we make TCFD reporting more accessible to a larger number of companies and also to a larger number of smaller investors, which is why we at Manulife Investment Management, we strongly believe in a lot of these collaborative initiatives led by Ceres, AIGCC and others, because that's bringing scale to a difficult space for a larger number of investors. The second part of the question is really around efficacy of indices and whether low carbon indices truly are low carbon. I think that it can be a very challenging space because there's a lot of proliferation of indices right now because there's a lot of interest in ESG investing, and it's really important to understand the methodology behind the index and to understand what is that index actually trying to achieve. So a majority of ESG indices out there today, whether they're called low carbon or ESG or whatever, the majority of indices that are actually gaining traction, actually gaining assets, are actually constructed in relation to a mainstream index. So they're constructed in a way where they're trying to reduce tracking error, so reduce essentially the performance and risk difference from a mainstream index. And that does introduce some limitations in terms of the amount of deviation away from a mainstream index that they're able to introduce. So it may be relatively low carbon, but not low carbon enough for you, depending on your view of the world or your preferences. There is no one definition of what low carbon looks like. So an index that's called low carbon that includes a coal-burning utility company may be a relatively better low carbon or directionally improving low carbon index, not actually a science-based Paris Agreement aligned index. So I think we need to be speaking with our index providers around producing indices that are actually using science-based targets, which are actually aligned with the scenarios that we're trying to achieve through the Paris Agreement. And then I think as investors, we need to be interrogating properly what's the actual methodology underneath the index and what's my actual intention as an investor. Some asset owners have a higher risk appetite than others. They're able to start to divest of certain industries. Others are much more bound either by regulation or by the expectations of their beneficiaries to be a lot more conservative and to inch along towards a low-carbon future. Regardless, I think that all plays a role, and we can all do our part in trying to usher in this low-carbon future.
Thanks so much, Emily, for that really comprehensive answer, and thanks everyone for submitting your questions. Just to quickly wrap up before I hand over to Robin, we hope you'll use this report to help identify where you may be facing increased risk in your portfolios and where you may need to do a deeper dive in your analysis and look through the recommendations that we've provided. And hopefully this provides you some guidance into what the areas that you can work on to address some of this risk. I just wanted to flag some sector focus areas that the Global Investor Coalition on Climate Change is working on with our partners at Ceres and the other groups. Emily mentioned earlier engaging at a sector level. So we will be producing in coming months investor expectations on the oil and gas sector, an updated guide, looking at real estate and also construction materials. So get in touch if you'd like to understand more about that process as it's underway now, and look out for when those reports are launched in coming months through the rest of the year. But thank you everyone, and with that I'll hand back to Robin from Ceres to wrap up the webinar today.
Thank you, Rebecca, and thanks to all of you who've stayed with us through the close of this webinar. Just putting a small plug in as we close up to check out not only the brief that's been the focus of the webinar, but the Investor Water Toolkit that Ceres has pulled together, and to reach out to us with any questions. But thank you all for tuning in, for your time and attention, and also a very special thank you to my co-moderator, Rebecca from AIGCC, as well as Darisha and Emily for sharing their insights on this brief. I will be sending out a recording and some additional links out in the follow-up notes to all who registered, and we will also be posting the recording within a few days on the Investor Water Toolkit website. So I hope you found this valuable. I know that I have, and I've learned quite a bit, and I hope you all enjoy the rest of your day. Thank you.